Thanks for having me.
Suffice to say, I'm really nervous. I think this time tomorrow it's going to be a different story. What has yet to be priced in? What could still catch markets by surprise?
Well, I do think the dollar could move up considerably from here. And that's something that, I'm reminded of the old adage from the Treasury Secretary John Connolly, who said, it's our currency, but it's your problem. When you think about the global financial system, how dependent it is on the dollar, not just as a reserve currency, but as a currency where most primary commodities are denominated, the primary settlement in terms of invoicing on a cross-border basis. Of course, in Asia, excluding Japan, there's 1.6 trillion US dollars of loans and bonds owed by the non-financial corporate sector. So I do think a disorderly upward move, disorderly downward move, depending on the way you look at it, in many developing market currencies could still be in the cards. And this is something, my own impression of the Fed is that they were trying to create the domestic political space through lower inflation to take the external sector concerns very seriously. The number of economies that could potentially need IMF bailouts, need a sovereign restructuring. I mean, it's a very long list of countries. Of course, these rate hikes, the upward pressure on the dollar is not helping matters. Unfortunately, inflation remains sticky, it's elevated, and they've not yet created the domestic political space to take those external concerns into consideration.
So the concern is that the dollar could go higher. What does the Fed need to say for that dollar rally to be persistent?
Well, right now, I think that the Fed had been guiding market participants to expect that they were going to stop raising rates. Now, from Jackson Hole, it's very clear they wanted to disabuse market participants of the idea that they're going to cut rates anytime soon, but essentially take rates up to 3.5, 3.75, and keep them there for really an extended period. Now, I think the calculations have changed. And so, yes, I do think the median FOMC participant with the summary of economic projections, the dot plot, where they expect rates to end up is going to have an enormous influence on Treasury yields. And as those yields back up, that's going to, I think, drive the dollar higher.
Jason, when you look at the globe, you've got a U.S. which is perhaps facing the storm clouds of a recession, given where interest rates are targeted to go to. You've got an energy crisis, which without parallel for a continent like Europe anyway, playing out there. And we've got also China with more and more signs of a slowdown, and of course, other emerging markets feeling it too. Are we going to hell in a handbasket?
Well, obviously there's quite a number of risks, as you outlined, over the next 12 months. But, in many ways, I'm actually more constructive on the 3 to 5 year outlook. The reason for that, first of all, is that when we think about really deep downturns in the global economy, they're always and everywhere a function of excess capacity. And then they're triggered when companies recognize that and try to shed assets, shed payrolls, downsize, cut losses. What's been revealed by the pandemic actually is not too much investment, not excess capacity, but in fact, too little investment over the last 10 years. I think following the global financial crisis, many businesses just became very worried about investing in anything that needs to be financed. So they cut back on fixed investment, cut back on inventories, working capital, et cetera. That left us in a very vulnerable situation, extremely fragile supply chains, not sufficient energy, as you suggested, energy security. Even in the United States, when you think about core inflation, 40% of core CPI is housing. Housing is running at 8% annualized increase in primary rents precisely because there hasn't been sufficient construction in the United States. About, estimates range between 1.7 and 4 million too few housing units. So for all these reasons, I do think the investment globally is going to pick up over the next 3 to 5 years. And that is going to mean actually somewhat faster growth over that period, although this may be very negative for margins, and it is going to also result in somewhat higher real interest rates.
Jason, with this happening, does it really give the global economy a bit of a cleanser? Do we sort out the wheat from the chaff after all this, and all the fragilities being revealed as a consequence of the tide going out, as it were?
Yes, I think that is something that inevitably happens when rates are taken to these levels. It's the situation in Japan for many years that people have suggested that just continually rolling over loans with interest rates at such low levels, actually led to problems being prolonged. And so I think in this situation, there are reasons, again, very difficult 12-month, maybe 18-month outlook, but again, reason to suspect that at over a 3 to 5 year horizon, that the economy is actually going to be in somewhat stronger shape as a result.
What would you be a buyer of if you're taking a 3 to 5 year time frame?
Well, so first, I mean, energy is most obviously, and that's certainly renewables, but it's also LNG. And I do think that when you look at LNG right now, the problem in Asia is that LNG is being bid away by Europe. And so there's just insufficient capacity on the whole. And I think that it would be wonderful to have a global price for LNG in the same way that we have a global price for crude oil. But that requires enormous amounts of investment. But again, I think it's very attractive. Right now, in the near term, the most attractive economy is certainly India. Not only the fastest growing major economy, but also an incremental return on capital, that is a sales or GDP per unit of, or you could say dollar invested, that's about 25% on an unlevered basis. So in terms of where your capital is having the greatest productivity today, it's certainly India. But in general, what I think investors should prepare for is over the last 10 years, again, the period after the global financial crisis, corporations actually didn't need your money. That is, the cash from operations was actually sufficient to fund all of the investment, with a lot left over. That, of course, went into buybacks, went into dividends, other distributions. Going forward, this reconfiguring of supply chains, building redundancies, it's going to be expensive. It's going to require external capital. So instead of just money coming in, bidding up the price of the same stock of assets, that new money is going to come in and actually buy new productive capital. That's the sort of change in the global investment environment we see over, again, a 3 to 5 year window.